Good day, guys. Welcome to Forex Walker. Welcome to episode 52. On this episode, on the previous episode, we were talking about the pound SGD. So, in the pound SGD, we had to exit the trade because of the negative 3.32 swap that I had to pay for holding the currency. So, I had to default into the pound CAD and I have last exited the trade because the CAD is actually becoming bullish, bearish all the time. So it makes it difficult for me to believe in the trade. So that's the reason why I exited. But this is why I believe the pound will be turning around and the market moving higher, especially because the CAD was getting weaker. Unfortunately, there's a high possibility that the CAD might get stronger. So that's the reason why I had to exit the trade. It is not easy to, throw away one currency and have to pick up another currency that you did not do a research on. So that's the reason why I had to exit the pound cat. So on this episode, we are going to be doing an analysis on the CAD, the macroeconomic analysis on the CAD. So what we're doing here is that we're looking for a hedge inflation trade where we hedge an inflation from one currency with an inflation on another. Now we're trying to catch a currency that is getting deeper and deeper into the recession, and we hedge the inflation of that currency with a currency that is about to exit the the recession. So it's something a hedge inflation trade is like monetary policy divergence, and it's the same thing as monetary policy divergence. The only difference is that these days we don't really get those actual monetary policy divergence trades because most central banks at this moment, it's highly unlikely for you to get a monetary policy divergence trade because um, central banks are entering the recession together and they're exiting the recession together. I've seen a monetary policy divergence with the Polish zloty, where they were hiking interest rates and at a time where the other currencies are holding. So that's part of monetary policy divergence. But when other currencies are holding and the Polish zloty is hiking, that is not necessarily a monetary policy divergence because the other currencies are holding. Uh, Usually, a monetary policy divergence is when one central bank is hiking interest rates and the other central bank is cutting interest rates. That's monetary policy divergence. But at the moment, we look for a currency that is about to be holding interest rates, but we need to enter the market before it holds interest rates. We need to anticipate that this currency had actually exited the recession. So here we have the GDP on the CAD, and what we were having our beautiful uptrend here. We had a zero point 0.9, 1.2. We were responding well to the cutting cycle. And we had a 1.2, 1.9, 2.3. Instead of moving towards the 3% benchmark, we actually had a fall from 2.3 to 1.2%, which is a disadvantage. It requires the central bank to actually uh, look forward in cutting interest rates, which we did get here. As you can see, we had our last interest rate cut on September the 17th. So we were at 2.75 and we had a 25 basis points. We are now at a 2.5% in interest rates. So let's look into the inflation. the inflation is actually responding well, but it is not balanced. If you can look closer into it, you can see that the 1.7% is actually stable. So even though we had the peak up here, but you can see that we fall back. So the inflation is not stable just yet. It is stable, yeah, at 1.7, 1.7, 1.7. Normally, I use these things like price action. So you can see that we're stable at 1.7 and we jumped to 1.9, we went back to 1.7, we jumped to 1.9. But because of this last interest rate cut here, there's a high possibility that the inflation might fly, might get enough strength to fly to 2.2%, 2.4%. That's what I wish to get in inflation. And I believe that might bring us out of this ditch of the 1.2% in GDP. Uh, I would really love it to get that for the GDP to get to 3.2. And when we do get that, I believe that the CAD will actually be ready to exit the recession. So as you can see here, we have been holding, and perhaps if we get all the way down to the 2% benchmark in interest rates, if we can cut, if we can get two interest rate cuts, 25 basis points, we can actually get to the 2% that we're looking for. So the unemployment rate gave us a jump, which is normally a bearish signal. So where we were at 6.9 and we jumped all the way to 7.1, which is our bearish signal. And because of that, we're going to be looking forward to selling the currency. In fact, the currency has been selling all this time. So when we look into, let's jump this. When we look into the trade balance, it is telling us to stay away from buying the currency because the balance of trade is it gave us let's check this. It says July, but we are now in October, or we should call it September because we're talking about the previous month. So this thing is delayed. It's talking about July, but we're actually not in July. We're in October. So we had a trade deficit. I could say since we are uh, July, August, September, October, we're behind by 4 months. This is April, May, June, July, August. So since August, here we've been in a terrible negative 7.57 trade deficit, and we have been picking up a little bit, but we need to exit these negatives so that we can start buying the currency. But for now, because of this terrible trade deficit, we are not looking forward to buying the CAD. So this is crude oil production in Canada. Even though you have a spike here, it says June, but it's not June, it's actually October. Even but it's talking about what happened on the previous month, which is September. So we had a spike from 4.42 all the way up to 4.85, which is uh, twice point 0.4. It's point 0.4 here, it's point 0.8 there. So it's just twice point 0.4. So because of this jump, crude oil only contributes about 10% of the Canadian GDP. So normally when you see a spike like this, it gets delayed by a month. It might take a month for the CAD to pump, but it might give us a pullback because it is actually oversold. But I will not be buying the CAD at the moment. So I just said the pound, but I didn't mean to say that. I was trying to say the cat. So this is WTI crude oil, and as you can see, it's giving us this prolonged downtrend, and we're looking at this while we were down here, and move on to the 50% feet up here, and we're actually moving back down here, which is the previous shoulder. We're looking for this previous shoulder or that previous shoulder, or perhaps it might turn around on this previous shoulder. So the market decides where it wants to turn around. Let me bring it closer for you to see. We have a previous shoulder here, right here, or the market might go to this previous shoulder or even this previous shoulder. So the market decides where it wants to turn around. But even if you see a turnaround, even if you see a spike all the way up there, you saw the the crude oil production is telling you that they had a big higher. But even if you see that, the CAD will not turn around immediately because crude oil contributes 10% of the GDP. So it's not something that we can invest in. Uh, so it will pump, but it might be delayed by 1 month because of the 10% contribution to the crude oil market. We also have a global supply chain that is actually in the negatives. Let me just jump in here and look for the global supply chain for you. Let's look for the global supply chain. Where's that global supply chain? Running out of time. I don't like searching things. Yeah. Oh no, this is not the global supply chain. Let's go back there again. Where's the global supply chain? Down here. Hope I did not jump it. Here is the global supply chain. So the global supply chain is currently in the negatives. We might get a bit lower, like here. We had a bit into the negatives and we had a bit lower. We might get another bit lower this month. And after that, I believe it will turn around and bring us back into the positives. And when that happens, all of the commodity currencies will turn around, and we can finally exit the 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 recession. We can actually buy these commodity currencies, the NZDs, the AUDs, and all of those currencies. So here it will turn around because of the. In fact, if you want to see where the oil market is going or the commodities in general, you need to look into the OPEC. The OPEC one in OPEC, what they do is that they only increase production or decrease production. Normally, prices are driven by scarcity. When they decrease production, uh, the guys who are governing the finance part, because OPEC does not govern the finance. There are people who govern finance. They focus on scarcity. When crude oil production is low, uh, crude oil becomes scarce, and what happens is that uh, the the crude oil prices they begin to increase, and that's how we end up going bullish on crude oil because the prices are increasing. They only increase because the production is an inverse proportion, but it takes time for us to understand what is happening in crude oil. So, guys, I will see you on the next episode. Uh, I'll try to talk more about crude oil, but not on this episode. Goodbye, guys. I will see you on the next episode.